Good afternoon, everybody. How you doing? This is Bob Iaccino from Path Trading Partners. Mike Arnold is here with me as well. Thanks again to Nadex for allowing us to chat with you guys. So let's get started. We've got a lot to cover, and there's a lot of information here. This is class 4 of our Nadex spread series that we've done. And this is Understanding Nadex Spread Greeks Part 1. We're going to do Part 2 next week. This is an extension of the moneyness concept that we talked about last Tuesday. Again, if you haven't seen that, you can go to this page. I'll show you guys real quick. All right? And you go into the Learning Center, and you've got Webinar Archive right there. You click on that, and you can see breaking down Nadex spreads. You look for our logo, and you could follow the whole spread series that we've done. But in the meantime, let's cover a quick risk statement, and I read this every time because we actually take it extremely seriously. This presentation is for information purposes only and does not constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. Only for use as general information. I've been learning to say general information lately. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and past performance is not indicative of future results. I ask everyone to please take this kind of a risk statement seriously, because what ends up happening all the time is we teach trading to people, and then right away they go headlong and they risk massive amounts of their own account, money that they shouldn't have in their trading account, and brokers are very happy with that, but you end up being not that happy. So make sure that you're able to lose what you risk, and then make sure you trade high probability setups and trade all of them. That's all we're ever trying to tell people to do. You need to be consistent in your trading, and you need to be responsible in your risk. So who is Path Trading Partners? Path Trading Partners is a trading and education firm. It was our mission to form a firm that educates, supports, and backs traders. We do seed capital for certain types of accounts, who are committed to probabilities, discipline, and long-term trading success. And this is achieved by following the correct path. We are not high-frequency traders, and we are not day traders. What we are is a firm that believes in a long-term success in trading, covering time frames dictated to us by products, markets, and price action. Mike Arnold is my co-founder. He's the Chief Technology Officer and the Chief Strategy Officer of Path Trading Partners. He's a 24-plus year market veteran. He's been teaching traders online and in person for 10-plus years, and he is and has been a strategy and development consultant to multiple hedge funds. I mention this in every webinar. Mike's job is to break systems. A hedge fund will create a trading system, and they'll send it to Mike and say, find the holes for us, and Mike finds the holes. You can imagine what a joy it is for me to talk to Mike all day when he's a professional devil's advocate. Former options market maker on multiple exchanges. He's traded in Chicago, New York, Switzerland, and Canada, and he is the current head of technology and trading system development for Path Trading Partners. I am a guy who's up in that corner picture there. I spent the last 24 years in the markets. I've been mentoring and teaching traders online and live since about 2002, and I've been a proprietary trader, a fund of funds principal, and a member of the investment committee for that fund of funds, which is where I think I bring value to you guys. I do television, as you can see from that picture. I wear a lot of pink. I've been on all the major networks. I will be on CNBC's Futures Now tomorrow, patting ourselves on the back for being right on crude oil the last time we were on Futures Now. And to date, I've done over 700 interviews on various economic, political, and market-based topics. I continue to make media appearances 5 to 10 times per month. I have our bios up here because I think it's extremely important for people to be able to verify who they're learning from. And it's not just somebody that says I'm a trader. You should be able to verify who you're taking instruction from and whether it's a fact or some sort of fiction that they've ever traded professionally. But let's skip over that subject, as uncomfortable as that may be, and go into a prior class review. In the prior class, we covered the concept of moneyness and how to know if a spread is in the money, at the money, or out of the money. This naturally leads into the concept of spread premium and intrinsic and extrinsic value. We looked at how to determine both intrinsic value and extrinsic value and the components that make up extrinsic value. It's the more difficult one to calculate. We also looked at the null point of Nadex spreads, where a spread is in the money but does not have any extrinsic value. So in this session, we're going to build on the concepts of intrinsic and extrinsic value. We will learn the spread price moves in relation to the underlying. We will learn how time until expiration and volatility affects extrinsic value. And in order to do this, we're going to examine the concept of the option Greeks. The Greeks are derived from the option pricing model. They help the trader understand the way an option price will react to different factors, including changes in the price of the underlying, volatility, time, and interest rates. Since you have already learned that Nadex spreads are constructed using option pricing models, we will investigate how the Greeks can be applied to Nadex spreads. Don't worry if you don't understand everything right away. You don't need to master the Greeks to trade Nadex spreads. This is what I mentioned earlier when I said there's going to be a lot of information in this particular presentation, and you don't have to master the actual level of each Greek, where the number is at a given time. But you do need to understand how the Greeks affect the trades that you're in order to profitably and successfully trade Nadex spreads. So what are the Greeks? The major Greeks from the option world are as follows. They are delta, gamma, theta, vega, and rho. A spread trader will mostly focus on delta, theta, and vega. Those are the three that are must-learns. You must understand what those are doing at different times in order to be successful trading Nadex spreads. Now, we can apply these Greeks to Nadex spreads, and the definition of each Greek is as follows. Delta is the sensitivity of the spread price to price changes of the underlying. So in other words, every time the underlying moves one tick, it doesn't necessarily mean that the option moves one tick. The difference between those is the delta. Gamma is the sensitivity of the delta to the price changes of the underlying. Theta is the sensitivity of the spread price to the passage of time. As it gets closer to expiration, how is the price of the option that you're in going to react? Vega is the sensitivity of the spread price to changes in the implied volatility of the underlying. It's an oft ignored thing by Nadex traders, applies to binaries and spreads, that volatility moves and affects the price of the option you're in without the underlying necessarily needing to move. So Vega measures that sensitivity. And rho is the sensitivity of the spread price to changes in the interest rates, and we will not be looking at rho, since we're trading spreads on a short-term basis, and rho will not affect the price of the spread the majority of the time. You're not necessarily going to ever experience a situation where interest rates change so quickly in one day that rho is going to affect a trade that you're in. And most of the Nadex spreads you'll trade will be same-day expiration. So we don't have to worry about rho. You should now be familiar with extrinsic and intrinsic value of a Nadex spread. If not, go back and watch the last one we did, and then rewatch this recording when they post it. You may have also noticed that the value of the spread does not move in the same way as the underlying instrument. This is due to the spread being constructed from options, and it can be explained by the Greeks. Something that you guys don't necessarily always realize, okay, is that these are options. Nadex spreads are options, and they're constructed with options, as we explained again in the last one. Now, we have to look at a pricing model, and in pricing models, there are limitations. In option models, there have been assumptions made in order to mathematically model the price of an option. Different models have some different assumptions, but many overlap. In these graphs, we are using a binomial model to model out the prices and the Greeks of the spreads. In the real world, you might at times see slight differences or variations in the way a traded spread behaves and the theoretical behavior that we're reviewing here. Now, some of the assumptions made in pricing models are as follows. The direction of the underlying cannot be predicted consistently. This has to be made. The price of the underlying is log normally distributed. This also is an assumption, has to be made for it to work out. The underlying price in any time period depends only on the price observed in the preceding time period. It's an assumption, it's not always true. Traders are risk neutral and indifferent towards risk. We know that not to be true most of the time. Commissions and fees are ignored, and those assumptions have to be made in order for a pricing model to mathematically work out. And then obviously you'll see some slight divergence in actual price, but we'll get into that. So, in the next slide, we will examine the underlying versus a 100-105 Nadex spread at 3 different points. We will look at the underlying at 100, 102.5, and 105. We can discuss extrinsic and intrinsic value at each point. Okay, so it's a 100, 105 Nadex spread, and we're going to look at 3 different price points of the underlying. The underlying will be trading at 100, 102, and 105. So, assuming 30 minutes to expiration, okay, this is spread price versus the underlying. Here you can see the graph at expiration is the blue line. 100 straight up to 105. Okay, you can see it right there, lines up. Now, with 30 minutes to expiration, this is the behavior of the spread in terms of pricing. Let's take a look at 3 examples. At 100, the spread has a value of about 95 cents. Okay, again, the green represents the actual spread pricing. This, again, is with 30 minutes to expiration. At 102, the spread has a value of about 250. Okay? And at 105, the spread has a value of about 405. You can see that graphed out right here. As the underlying moves from 100 to 102, the spread value has moved from 95 cents to 250. The value of the underlying has increased by 250, but the spread value has only increased by 155. That's a visual representation. Delta is the difference in the move, not the difference in price, not subtraction, okay, but the difference in the move between the underlying and the actual option. As the underlying moves from 102 to 105, the spread value has moved from 250 to 405. The value of the underlying has increased by 250, and the spread value, again, has only increased by 155. I'm going to turn it over to Mike now to explain how this delta works.
All right, great. Thanks, Bob. Thanks for that brief introduction and going over. So you guys should now see that the option price does not move, or because the spreads are made up of options, the spread price does not move the same amount that the underlying moves. Well, that's because options don't move at the same rate underlying. They would if the delta equaled 1, and when we get into that, you'll understand what that means, but a lot of times they move a fraction of what the underlying does, and it's not a constant fraction, it's variable, it varies. That's why this is not a linear. It's only linear on expiration, the price changes. But prior to that, it's not linear. Like going from 98 to 99 is not the same as going from 100 to 101 in terms of price changing of the option spread. It's the same difference in terms of the underlying change, but the spread does not change the same. So, what is the delta? The delta is the sensitivity of the spread price to price changes of the underlying. So it's how much the spread price is going to change based off of a change in the underlying. We just saw that by noting in two different cases that the spread did not increase as much as the underlying given a certain time to expiration. And this is also at a certain implied volatility. Even if we do not state the implied volatility on some of these graphs, we're assuming that the implied volatility is constant and does not change. Please keep in mind as we go through all the following graphs that they are simply a representation of the Greeks and not an absolute value. Don't try to memorize these values. Don't try to, because it depends on a lot of factors. It depends on, again, the implied volatility. It depends on the time to expiration. It depends on the price of the underlying. It depends on the underlying has moved, et cetera, et cetera. Those are all inputs into the pricing model. The absolute values depend on the volatility, underlying price. The difference between the floor and the ceiling prices, that's another one, because the farther apart or closer together the floor and ceiling prices are, that will change the delta. So here's on a theoretical 100-105 spread, here's the delta. And this is, delta is based off a 1 point move in the underlying. So if you were down here at, let's just say right above 97 here, and it moves from, let's just call it 97.25 to 98.25. If the underlying moved about that, you'd expect the spread to move 1/10 of that amount, okay? If we were up here right in the middle, where the delta is highest, right around this 102.5, right in the middle, where we consider the null point we've talked about in previous webinars, the delta is going to be about the highest. And so if it went from 102.5 to 103.5, the spread is going to change about 75%, or 75 for the $1 change in the underlying. So you can see how, depending on where you are in the curve, the delta is different. It's highest at the money and very close at the money. It's lowest deep out of the money and deep in the money. So if a spread's deep in the money and you get a change in the underlying, the spread value is not going to change that much. Deep out of the money, you get a change in the underlying, a 1 point change. It's not going to change that much. Close to at the money, it's going to change a lot more. So the key takeaways of the delta versus the underlying price. Delta of a spread is highest near the midpoint of the spread. All right? And I'm sorry I said at the money. I meant in the midpoint, in the null point. Delta is lowest below the floor price and above the ceiling price. Let's just go back and look at this. So the midpoint of the spread, a 100-105 spread, 102.50 is the midpoint. That's about where the delta is going to be the highest. It's going to be the lowest below the ceiling, or below the floor and above the ceiling. Well, the ceiling in here is 105, so you can start seeing as it get above the ceiling, it starts dropping off rapidly. Below the floor, below 100, it starts dropping off rapidly. Delta rises as the underlying approaches the midpoint of the spread. Delta falls as the underlying passes the midpoint and approaches the ceiling. So let's just look at those again. As we approach the midpoint, you can see it getting higher and higher and higher, and then it starts falling as we pass the midpoint and approach the ceiling. So that's the general shape of the delta graph. These numbers will change. This is at a specific time to expiration and a specific implied volatility. Every minute that this spread, that time decreases and it gets closer and closer to expiration, this curve is going to slightly change. If we also change the implied volatility of this spread, it will also change. The shape will roughly remain the same, and we'll go over those. I'll show you some other graphs, but it's going to change the values. All right, it's more important that you understand the key delta points we just examined and the absolute value of the delta at each point. Let's take a look at what different values of the delta means. If the delta of a spread is 0.5, then as the underlying increases $1, the value of the spread will increase $0.50 or 50%. If the delta of a spread is 0.8, then as the underlying increases $1, the value of the spread will increase 0.8 of a dollar or 80 cents or 80% of the value that the underlying increased. I mentioned a little bit ago the delta changes versus time. We're holding in this graph, we're holding the implied volatility the same, and we're just changing the time. So with 60 minutes to go, again, this is a 100-105 spread, so if you look in the middle where delta is the highest, with 60 minutes to go, a 1 point change the underlying, it's only going to be about 0.6. Okay? So it's going to change roughly 60% of the underlying. The spread will change in value, up or down. With 30 minutes to go, if we're still trading right around that same area, the delta goes to 0.65 approximately. 10 minutes to go, it goes to 0.75. 5 minutes to go, it's nearly 0.9. The only thing we're changing here is the time, the amount of time until expiration. This is the amount of time until expiration. You can see that if we're in the middle of the spread, the delta, as you get closer and closer to expiration, the spread moves faster. It moves closer to 1-to-1 with the underlying, okay? As it gets closer and closer, it's still a fraction of it, but as it gets closer and closer, it moves 1-to-1 until just before, theoretically, just before expiration is virtually going to move 1-to-1. Now, let's look at it. Here's the floor. So we go drop below the floor. We've covered this before. This would be out of the money. Down here, this spread is out of the money. So let's take a look at it about 97. If we were trading this spread, let's say we were long this spread and the underlying's trading at 97. Well, with 60 minutes to go, if the price goes from 97 to 98, the spread's roughly going to change by 15. For a dollar change here, it's going to change by 15% or about 15 cents. However, with 30 minutes to go, if we have that same move, it's only going to be about 10 cents for that dollar move, or 10%. 10 minutes to go, it's going to only change maybe 0.08 or 8% of that spread. So you're seeing how it gets worse and worse. So as time gets closer and closer to expiration, and this spread is still out of the money, you don't have as much delta. The spread does not, it continues to move slower and slower as it gets closer to expiration. So it gets harder for this thing to get into the money. It gets harder for the spread to increase in value as long as it remains out of the money as it gets closer to expiration. Here's our ceiling price, 105. So we're above 105. Now the spread, if we stay above 105 and we're long this spread, it's going to, expire at full value. But prior to that, it can still change in value because it's not valued at full value prior to expiration. Okay, if we purchase this spread with 60 minutes to go, we purchase it when the underline's at 105, if it stays there, it's going to eventually be worth that full value of the $5, the difference between the floor and the ceiling. However, prior to expiration, we aren't going to be able to purchase it for 105. We're going to purchase it cheaper to 105. So if it continues to move up in value, the spread will move up in value, but it won't move up as fast. It will still increase. Let's say when it was trading at 105 with 60 minutes ago, we bought the spread at about 103 or $3, in the money. Well, if it then goes to 106, it's roughly going to go from $3 to $3.45. So you can see it's still going to increase in value, but it's just going to increase slower than the rate of change of the underlying, even when it's in the money and even when it's above the ceiling. So the key takeaways of delta versus time. If the underlying is near the midpoint of the spread, the delta will increase as time gets closer to expiration. If the underlying is below the floor price, the delta will decrease as time approaches expiration. If the underlying is above the ceiling price, the delta will decrease as time approaches expiration. I mentioned before we were holding volatility constant. In this graph, we're not. Now we're holding time constant. The only thing that's changing is volatility. And a couple weeks ago, we mentioned that volatility is very similar to time in the way options behave. So here's another example of how it sort of looks similar. The graph is not exactly the same as the time graph, but it's a similar shape and it has similar characteristics. So in this one, again, let's pretend this is with 30 minutes to go in the trade. If we're here at the midpoint between the spread, 102.5, and we're at 40% implied volatility. The delta is only going to be maybe 0.45. So it's going to move 45% of what the underlying does. If the implied volatility goes down to 30%, you can see your delta going up. It's now maybe 0.55. 20% it's going up to maybe 0.75. 10% is going up really close to 1. You know, it might be 0.95. Why? Because lower volatility has the same effect as less time until expiration. So there's lower the volatility, there's less potential outcomes that can happen to the spread. So your spread price will change more rapidly when it is in the middle. The opposite's true when it's out of the money. We're down here out of the money, below the floor price for a long. And look at this. As volatility goes down, the spread price does not move as much with the underlying. So when it's up at 40% volatility, you know, let's say we're trading at this 97 again, we go from 97 to 98, the spread would increase roughly 20%. However, with only 20% volatility, the spread is going to roughly increase, it looks like it's below even 0.1, so it's going to be under 10%. And with 10% volatility, we're virtually down, I mean, this could be 0.01 or 0.02. It's going to move very little. So changes in volatility affect your spread or your delta, and depending on where you have the spread on and where the underlying is, it's going to affect it differently. It's not just one curve. The implied volatility can drastically change how your spread behaves with changes of the underlying. Higher implied volatility, spread does not move as much when it's closer to the middle than with lower volatility, but when it's deep out of the money or deep in the money, it actually moves more with higher volatility. Key takeaways. If the underlying is near the midpoint of the spread, the delta will increase as volatility decreases. If the underlying is below the floor price, the delta will decrease as volatility decreases. When the underlying is above the ceiling price, the delta will decrease as volatility decreases. I mentioned this before, time and volatility, you can see how similar the curves are. There's slightly different nuances, but they virtually look the same. You know, less time and less volatility, those are both the blue lines. They're both higher at the midpoint and lower deep out and deep in the money. You have lower volatility or higher volatility and more time. Your delta is higher when it's out of the money or deep in the money. So many of the graphs of the Greeks will look similar between time and volatility. An easy rule of thumb to remember is that more time is similar to more volatility, or more time until expiration is the same as there's more implied volatility in the option model, which can mean that there's more volatility in the underlying, but it doesn't have to mean. We've covered that again in prior sections. I'll just recap it now. Implied volatility is based off of what the market makers in their models think the market will do. So if it's even high volatility now, but they expect it to really get quiet, maybe it's going into lunchtime or maybe we're going into a news release. Implied volatility can actually be lower in the model than actual volatility in the market. Or maybe right before a news release, volatility is really low in the market. You know, everybody's waiting to trade until that news comes out, but the option market makers can have a high implied volatility in their model. Think of it this way: if there's more time until expiration or greater underlying volatility or greater implied volatility expected, the more possible outcomes are possible and affect the spread in similar ways. So there's more time, there's more possible outcomes that could happen to the spread. There's more volatility, there's more possible outcomes that could happen to the spread, meaning it could move out of the money, it could move farther in the money, it can change a lot more. That's why there's same with more time. With an hour to go, there's more possible outcomes versus 3 minutes to go for the spread. Let's now dive into gamma, and we're really covering gamma for the point of completeness. The definition of gamma is the sensitivity of the delta to the price changes of the underlying. So The delta is the rate that the spread price changes based off the underlying. The gamma is the rate that the delta changes based off the underlying. A great analogy is to think of delta as velocity and gamma as acceleration. Don't get too hung up on gamma. We're mainly including it for completeness. And if you're an advanced option or spread trader, you know, this will make sense. If not, don't get hung up. Don't fret about gamma. It's just now we have to expose you to it. So if you know people are talking about it, what does gamma mean? Well, now you know it's the rate of change of the delta. Just as delta is the rate of change of the price of the spread, gamma is the rate of change of the price of the delta, or the value of the delta. So here's what the curve of a gamma looks like. It's positive until you pass the midpoint of the spread. At the midpoint, it's a 0, and then it drops negative. And it returns the farther deeper in the money, it approaches 0 again. That's what the curve of the gamma looks like. So, key takeaways of gamma versus underlying price. Gamma is positive and increases as the underlying price approaches the floor price. So, as the underlying price, here's the floor price, 100. As the underlying approaches it, gamma gets more and more positive, meaning the delta will increase. I'll show you the gamma side by side with a delta graph, and it's easier to see how the two interrelate. Gamma is positive and decreases as the underlying approaches the spread midpoint. So as the underlying approaches the spread midpoint here, it's still positive, but it's decreasing. It's approaching back to 0 again. As the underlying price passes the midpoint, gamma turns negative and continues to decrease. And then as the underlying passes the ceiling price, gamma is negative and begins to increase again. So let's just recap those with the graph. So we pass the midpoint. It continues to decrease until we get to that ceiling price. And as we pass that, it's still negative, but increases, meaning it gets closer and closer back to 0. All right. Here's an easier way to look at gammas and deltas. So you notice this is not a linear curve. It changes its steepness over time. Well, as it gets steeper and steeper, that's because the gamma is getting more and more and more. It's increasing the rate of change of the delta. That's why it's sort of like acceleration. So as you see, the delta is increasing, increasing, increasing. At some point, right as we start passing this, the floor price, see how the gamma still is positive, but it starts dropping off. It's not increasing as much. Well, here's the floor price. And now we've been going steeper, 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 steeper. This still increases, but it starts leveling off more because it's not increasing as fast. Right in the middle here, here's right in the middle. Now this is where it starts going negative. Gamma is going negative. So now it's every movement of the underlying in a more positive fashion here will actually start taking away from the delta. That's why the delta is decreasing in value. Delta still remain positive, but gamma is taking away from it. So it's now, when it's negative here, that's why this curve is decreasing. And that's why it decreases more rapidly, but then as we pass the ceiling price, it actually slows its rate of decrease because this, again, approaches 0. So you can somewhat see how those interplay together. Gamma versus time. So remember, as we got closer and closer to expiration, when we're right in the middle of that spread, we had major changes in the deltas, and this is because the gamma, again, as we get, depending on where you are on the curve, when we get closer and closer to expiration, okay, it can really affect the delta even more. So 60 minutes to go, you know, your delta does not change as much at certain areas on the spread, either higher or lower. But as we get closer to expiration, the gamma starts changing, gets either more positive or more negative at these floor and ceiling prices, and that affects the delta very rapidly at the floor and ceiling prices. So, as time to expiration decreases, the gamma of the spread decreases if the underlying is significantly below the floor price. As the time to expiration decreases, the gamma of the spread increases if the underlying is between the floor price and the midpoint. As time to expiration decreases, the gamma of the spread decreases if the underlying is above the midpoint but below the ceiling. And finally, as the time to expiration decreases, the gamma of the spread increases if the underlying is significantly above the ceiling price. I'm going through this quickly. I just wanted you to see how that curve looks and how it changes versus time. It's not important that you study this in depth. It's more important that you understand the concept of delta. Just understand how gamma affects delta and why the curve of the delta looks the way it does. As with delta, the absolute value is not necessary to know. It's more important to understand where gamma is the highest and lowest, positive and negative. If the underlying price increases by $1 and the spread is a gamma of 0.2, it means the delta of the spread will increase by 0.2. Okay? Not the value of the spread, but the delta will increase by 0.2 if the gamma is 0.2. If the gamma was 0.02, the delta would increase 0.02. If it was negative 0.02 or negative 0.2, then it would actually subtract that amount from the delta. So if the underlying price increases by $1 and the spread is a gamma of minus 0.1, then the delta of the spread will decrease by 0.1. So let's say the delta was 0.5, the delta would then go to 0.4. Here's just a comparison for the point of completeness, gamma versus volatility. Very similar to time. Lower volatility has the same effect on it as less time. You can see it spikes at the floor and the ceiling with very low volatility. Higher implied volatility has less, means the effect of gamma does not affect the delta that much. So generally gamma behaves in the same reference to decreases in volatility as it does in time as expiration gets closer. And it's most extreme at the ceiling and the floor prices. Let me just go show you those graphs side by side. I don't have one with them side by side, and then I'll turn it back over to Bob. So that's what it looked like with volatility. And you can see if I go back here, that's what it looks like with time. Imagine those side by side. So again, there's time. There's volatility. They look very similar. That's why, if you just remember, less time is the same as lower implied volatility. All right, Bob.
So far, we've covered an overview of the Greeks, the concept of delta and gamma, and we investigated how delta and gamma react to time and to volatility. This, again, is a lot of information, okay? It's just the first part of the presentation, so please take time to review it. There was a question earlier about which Greeks were important for Nadex spread traders, and I didn't answer that question because it was going to be answered through the course of the two presentations. We've got delta and gamma investigated in this one. We'll get into vega in the next one. Those are really the ones that you need to focus on. That's why I didn't answer your question.
And theta.
And theta, right. So continuing in the next session, we'll finish covering the concept of theta and vega, there you go, and how time and volatility affect the pricing of a Nadex spread. Now we know that this is advanced information. It's going to take some time to absorb, which is why we're taking our time teaching it, presenting it. So please rewatch this webinar and reach out to us with any questions at pathtradingpartners.com. There is, it's easier to get a hold of us by emailing there as it is to calling the phone call or calling the number that's on our website or anything like that. So please, we're going to stay and answer any questions, but if you could follow us on Twitter at @path_trading, like us on Facebook, visit us at our website, again, pathtradingpartners.com. And there's a lot of free stuff there and free webinars you can sign up for. I'd love it if you'd watch our archives on the Nadex site as well, because that'll give you some background on what we're talking about here. And again, my favorite thing, please listen to our podcast, The Money Path, which can also be found on our website or on iTunes. So if there's any questions, we're happy. Which Greeks are the ones we're going to mainly look at with Nadex? That's the same question, right, Lori? This webinar is Class 4, Part 1. Where can I find on your website the list of all your classes regarding Nadex binaries and spreads? You just go to Path Trading Partners, go to Shop. You'll see a tab that says Training. Okay, one of the tabs on top says Shop. You hit the down arrow on that, go to Training, and everything is there. We try not to make our Nadex webinars a sales pitch. So you can just go to our website. Everything's there. It's pretty self-explanatory as to what we teach. And again, most of the stuff that's specific to spreads, here's something a lot of people don't really understand. You have to have a trading strategy to trade anything. Okay, we have strategies that apply to any markets, and they can apply to binaries and spreads. And that's what we charge for you guys to learn. The rest of the stuff, the breakdowns of what the spreads are and how they work, you can get them on our website, which I'd prefer you do. If you guys sign up, then you get any sort of emails about what we're doing that's new. So take a look at that. Just sign up on our website. You don't have to pay anything. You don't have to enter a credit card. We're not like that. You can just go look at all the free stuff that's on there. And then there are courses on there that are for sale, and they're specifically strategy courses, things that you guys need in order to succeed in any kind of trading, not just binaries and spreads. So that's lost on a lot of people. So you have to have an actual trading strategy for the underlying that you then impart your view in the Nadex spreads and in the Nadex binaries, which is a very low risk, controlled risk environment, which is very, very good for beginners and novice traders if that's what you guys are. But it's also a useful tool for experienced traders. So we like the spreads as experienced traders. The binaries are a great product as well. So check all that stuff out on our website. Not seeing any more questions, but I'll stick around a few more minutes in case there are any more. Enrico, I hope I answered your question. Lots of questions, but lots of studying to do first. Appreciate the education. Thanks, Gary. You're welcome, Enrique. I'm sorry, Enrico. Don't want to mispronounce your name. Iaccino gets mispronounced all the time, so I'm very sensitive to that. All right, guys. Well, again, you can reach us on our website. Again, please sign up so you can hear about the other things that we're doing. We've got an article out on Top Shelf Traders, which is Trading Pub's publication. If you want to check that out, we're doing a webinar for them tomorrow on a specific, particular trading tool. I wish I had the link for that, but I don't. But I don't really care. We're not looking for credit. We're just looking for you guys to learn stuff. So thanks to Nadex for allowing us to teach you guys, and we will speak to you guys next week, Tuesday, same time as always. Again, pathtradingpartners.com. Thanks, Nadex. We'll see you guys soon.